Today's episode is brought to you by 𝐬𝐻&BUCKLEY Law Firm. Smart business owners recognize that sound legal advice is critical to future success. The attorneys at 𝐬𝐻&BUCKLEY have been providing legal guidance to families, business owners, and C-level executives since 1997. From employment law and compliance issues to buying, selling, or merging companies, the corporate attorneys at 𝐬𝐻&BUCKLEY advise businesses across a wide variety of industries and professions. Over the years, co-founders Andy Kelleher and Dave Buckley have assembled a team of highly skilled attorneys to create a full-service law firm. I've gotten to know and have done deals with Andy Kelleher, Dave Buckley, and their team. They are truly a full-service law firm with outstanding talent. To find out how they can help you protect your assets and your future, contact them at kelleherbuckley.com. That's KELLEHERBUCKLEY.com. Hope you enjoyed today's episode. Thank you.
Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Dominic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Dominic Rinaldi.
One of the common sayings in mergers and acquisitions is, it's not necessarily how much you get for your business, but rather how much you keep in your pocket. Well, today we have an expert in the matters related to tax, business succession, retirement and estate planning, strategy, and the tax aspects of business decisions for closely held and family businesses, Dr. Bart Basi. Dr. Basi has achieved so much in his career that reciting his accomplishments could easily take up the entire podcast. My personal experiences with Dr. Basi have been life-changing for my clients who retained him to help them better structure their M&A transactions. Dr. Basi, I could go on and on about your impact on the M&A industry, and it's such a pleasure to have you here today.
Thank you. It's a pleasure to be here.
So, Dr. Basi, maybe you could start with just, a brief overview, bio on yourself and on your firm, so the audience, the M&A Unplugged audience, has a sense for, what you do.
No problem. Actually, when you hear my bio, you can say, gee, that and maybe $4 can get you a cup of coffee. But I'm a CPA. I'm a licensed attorney. I don't practice law as a litigator at all, but I'm a licensed attorney in several states. I hold a master's degree in tax. I've got a PhD in economics, and I've got postgraduate work in tax from Stanford University. I was a university professor for 36 years or so and taught mergers and acquisitions, entrepreneurship, and taxes. Currently, I teach continuing education courses for attorneys in 31 states and also some continuing education courses for accountants. And for the past 7 years, the Internal Revenue Service has a program where if you're a tax return preparer and you want to be registered with the Internal Revenue Service, you need to take 18 hours of continuing education each year and pass an examination. So if you took the 18 hours of continuing ed in 2018 and passed the exam in 2018, then in 2019, you're registered with the IRS to file tax returns for 2018. Now, for the past 7 years, I've been teaching the classes and also writing the exam for the Internal Revenue Service. So having said that, I've also been involved as an advisor to businesses, law firms, accounting firms, all over the world, as a matter of fact, Canada, Mexico, and just today, as a matter of fact, talking to someone from Sweden and assisting them in structuring the transaction. And as Dominic has said, the key objective is to make as much money as possible and pay as little taxes as possible in a transaction when you're selling. And when you're buying, it is extremely critical to structure the transaction properly because of the tax applications, especially in the United States, extremely favorable if the buyers handle the transaction in a certain fashion. Dominic, that's about it.
Yeah, well, look, it doesn't even scratch the surface on your knowledge. I mean, it's overwhelming, but in practice, what you've been able to do for clients for so many years is really amazing. And one client in particular that I can think of many, many years ago, I don't even know if you remember this transaction, but we had taken, it was a C Corp, and we had taken that deal to the client's accountant, and they did the tax workup, and it essentially had a net tax effect of 52% for our client. And we knew, because we had taken some of your seminars at IBBA and some other places, that there was a better way to structure that deal. We got you engaged in that client's account, and lo and behold, you saved that client about 75% of the tax bill that their accountant had given them. It was amazing, and well worth every penny that our client paid you for that analysis and then all the ensuing work that followed. So, that's the kind of results that can come from having an expert involved. So let me start there and launch into the first question, which is, are you surprised after all these years at how little preparation owners do around the tax ramifications of a potential sale?
Yes, I'm amazed every day. And a lot of times it's not just the client, it's the advisors that they have that don't really understand the tax ramifications. Many accountants I work with, many business people, many brokers I work with say, well, if you sell your business, you got to pay your taxes. Well, yes and no. That's not necessarily true. I mean, the structure of the transaction is so important, and there's so many tax benefits. Let me just give you one quick illustration. There's a tax law in effect right now, and this, by the way, this podcast is being done in December of 2019. This is important for me to inform everyone of the date of this podcast, because tax law changes, so that what I say today, I can't promise will be the law in a year from now, or 6 months from now, or even 2 weeks from now. It's very sensitive. But to give you a quick example, the law says that in 2019, if you form a corporation or buy a company, buy the assets of a company, okay, and set them up as a C corporation and run that corporation for 5 years or more, would you believe you pay no income taxes on the first $5 to $10 million of profits? Correspondingly, if you have a C corporation, it's for sale, and the structure of the C corporation is proper, when you sell that business in 2019, the tax law that was in effect at the time you created the C corporation will control the taxes that you pay when you sell.
So let me make sure I understand this. So if you formed a C Corp in 1956.
Well, that goes back a little too far.
All right. Well, if you formed it in 1972, is that okay?
Yeah. Yes. Yeah. Okay. When you formed it, right.
1972, and you sell that C Corp in 2019, you're going to be under the tax laws that were in effect in 1972?
Well, there's a special tax law. This is a special tax code.
Okay.
So it's not just the general laws as such. It's the law that controls the profit when you sell a company. I'll give you a specific example instead of generalizing. Nashville, Tennessee. I can't identify companies, obviously, but I can give you cities or states. Nashville, Tennessee. In 2018, someone comes to me and says, Bart, I've got a client. He's selling his business in Nashville, Tennessee. Can you help? So I took a look at the company. The company was formed in, I believe it was like 1996. Okay? And he had formed the C Corporation back in 1996 and had been paying taxes accordingly. In selling his company in 2018, I was able to go back to 1996 and found that in 1996, there was a special law that said if you ran the company and sold it in the future, like 2018, 50% of your profits would not be taxed in the United States. And the other 50% of profits could not be taxed any higher than 28%. It could be taxed lower, but not higher. So think about that for a second. What we did was, this gentleman sold his business. We filed his tax return in 2019 for 2018. He made approximately, I'll round it out, $5 million of profit in the sale of his business. So $2.5 million was not taxed at all. Absolutely free. So then he had $2.5 million of profit, and this is net of all the expenses of selling. Okay, so his profit might have been $6 million, but he had $1 million, let's say, of expenses. Anyway, so he's now got $2.5 million that's taxable, And of course, capital gains applies in 2018. So he paid 23.8%. And that 23.8% was only on 50% of the profits. So if you actually take a look at it, he actually paid an effective tax rate on the net profits of 11.9% on his entire $5 million profit.
Wow.
By applying the 1996 law and applying the capital gains law in 2018.
And we may be getting too far in the weeds here, but let me ask this one clarifying question. Was the tax at the corporate level, or did that 2.5 million flow through to him personally and get taxed at 23.8? Or was that the corporate tax?
Okay. What it is that this is what I'm referring to is the individual tax, not the corporate tax.
Not the corporate tax.
See, there's a difference. If you sell assets, then the profit goes into the corporation and then has to come out of the corporation.
Mm-hmm.
That's a different structure. If you sell stock, then the profits go directly to the individual. So if you sell stock, the tax law that I'm talking about right now in this Tennessee operation went to the individual.
So to be clear, that was a stock transaction.
Stock transaction. But be aware that in many cases that happened in Tennessee, there's an elective provision that allows the buyers to convert a stock transaction to an asset transaction for their purposes so they can get a stepped up basis. So it gets a little bit, it's not as simple as you think, okay? And I guess I tease my staff, that's why I get the big bucks.
And what you really illustrate, I mean, we're talking about one state in one simple transaction. Now take that out to 50 states. I mean, it just gets very complicated. So I think you're illustrating the point that having the right advisors, the tax advisors, really matter.
Yeah, I'm working on a case right now. I had a meeting with the CPA last week. I've got another meeting this week with a CPA from Dallas, Texas. They sold a company there. I've saved them a little over $5 million on the transaction alone. And now I've got it structured such that on the remaining profit, which is about $14 million, a fairly good size operation, they will pay no income taxes at all. And this is federal. And this is the individual.
Wow. And
this was a partnership structure.
Now, just curious, when did you get involved in that transaction? Was it already on the market and was there an offer in place?
Let me think about that one a second. On that one, yes, there was an offer in place. They were negotiating. They contacted me. In that particular case, their professional advisor had heard of me. Never met the man, by the way. It was a gentleman. Never met him, but he had heard of me, and he called me, and he says, can you look at this before we go any further and help us structure it? And so I said, sure, I'll take a look at it. So I looked at it, the way you would go and look at a contractor would look at a job to see whether he could take it or not and if he could do anything. So I looked at it, I said, yeah, this looks like there's some room for negotiation. And the buyer had a law firm in Boston, Massachusetts that I worked with, and we were able to structure the deal. And then I worked through the whole transaction, and now I'm working with the CPA filing the tax returns for them.
Wow. And
making sure. I can't guarantee what I do unless I'm involved in helping the professional file the tax returns after the transaction. That's critical. You can say, hey, I can save you taxes, or I can structure the deal. Structuring the deal is important. The letter of intent or term sheet when you first start, that's the best time to get me involved in it, so I can help structure the transaction and work with the buyer and the seller. And in some cases, I can save the buyer some money by lowering. In this particular case, by the way, I'm mentioning it, I actually saved the buyer some money, but saved the seller a tremendous amount in taxes, because, as a matter of fact, as I said, I'm not exaggerating when I say this, it's about a $14 million deal, $14.8 million deal, and there will be no income taxes paid to the federal government. And it's legal. I don't want to tell you it's ethical, it's legal. And just to let your listeners realize, because I'm a subcontractor and I work with the Internal Revenue Service, I get audited occasionally. And as a retired university professor, the last 2 times I was audited by former students of mine. So
yeah, be
aware I'm very sensitive to how I structure these transactions.
And I know you stand behind whatever work you do as well. I mean,
absolutely.
You are willing to, if the IRS shows up, you're willing to go side by side with a client to defend them.
Yeah.
Let me ask you, so you mentioned the best time to involve you is when there's a letter of intent in place, but is there some merit to having you come into the process early on while the intermediaries or investment bankers are prepping the deal before it gets to the market?
Yes, let me give you, and again, I'd like to give specific examples instead of generalizing.
Yeah.
Approximately 1 month ago, I was called by a firm in Salt Lake City, Utah. They're being sold to a firm in Brussels, okay? They called me because they knew about me, and their banker said, call Bart before you do anything. They have done nothing yet other than having an inquiry from this company that wants to buy them, very serious inquiry, because the company that wanted to buy them said, can we send our people in to look at your operation? So I said, whoa, slow down. Now, they have no letter of intent yet. They have no broker involved. This is strictly one of their people, I got to be careful how I word this, a related operation in Brussels that says we want to come into the United States and buy this company. And this is the only company we want in the United States. So what I'm doing is I had a meeting with the people out there. I flew out there to Salt Lake City. We sat down and we came up with a complete game plan. We're hiring another firm, independent firm, to value all the equipment in the business. It's a manufacturing facility, by the way, valuing everything in the business, even if it's not on the books that they've depreciated. Then we're going to go ahead and restructure all their financial statements. I've been working with their accountant. As a matter of fact, I had their accountant make some adjusting entries before they closed the books in 2019. We've also been in communication with the buyer and asked them if they would wait till the end of January so we can then go back and take a look at the closing of the books of December 31st of 2019 and restructuring the financial statements so they're all properly organized right, and then being able to present them with a complete package. These are the assets, this is the goodwill, and we calculate two kinds of goodwill in these cases. We calculate company goodwill, a lot of people refer to as enterprise goodwill, and there's also personal goodwill. They're separate items and they get taxed differently in the United States. To a buyer, they love it, okay? Because if you create goodwill in a company, you can't put it on your books. But if you buy goodwill, whether it's enterprise goodwill or whether it's personal goodwill, you can put it on your books. So, yes, this is a specific example of where I've gotten involved even before they had anything in writing, but the buyer has been identified, and it's a very good buyer. As a matter of fact, my clients have had a meeting with the buyer's president and CEO of the Brussels company, and they have said, justify whatever you want, we'll pay whatever it's necessary as long as it's, you can verify everything. So this is the reason I'm asking them to get an independent appraisal of all their equipment before we even go further, and then we'll adjust the books because everything's been depreciated over the years. Does this give you an idea? This is a specific going on right now as we speak.
Yeah. So you've brought up a term that I think a lot of people in the audience will be very curious about, which is personal goodwill. And in the case that I referenced at the beginning of the podcast where you came in and helped one of our clients, if you remember, it was a property management company. This was the strategy that you deployed in that particular case. It's a C Corp, and you determined that they could allocate personal goodwill in that situation, and it saved our client a tremendous amount of money in taxes. So maybe you could talk a little bit about personal goodwill. What's the hurdle or the metric to determine if it's really personal goodwill, and what's the net effect for people?
Okay, good question. Very, very good question, and it's a very important topic. Whenever you're dealing with and let's stay with the C corporation for the time being, okay? Partnerships is another matter. But let's say you've got a C corporation. Remember, I mentioned that there's company goodwill, or what we call enterprise goodwill, okay? That's the ability of the company to make a return that's greater than the average in the industry. And they've created a goodwill because of their products, because of their management, because of their bank relations and what have you, so they can actually increase their profitability, okay? Separate from that is the goodwill that's created because of the personal relationships of the owners of the company. Now, I'm talking now about private companies, not publicly held companies. And normally in a privately held company, no matter how small or how large, there are personal relationships that create value to the business. And an example would be an owner who, when you talk to the clients, the buyers of their products or their services, and they say, oh, gee, we know the owner, we know Fred, we know Mary, we know them personally, my goodness, they're so good, we would be happy to work with them anytime. Well, that is what we call personal goodwill because there's value to the knowledge of this. I can give you two examples on this. One is in Connecticut, a funeral company. Now stop and think of a funeral company. What creates personal goodwill? Well, business comes to a funeral company because, unfortunately, someone passes away and they need to have a funeral company handle the transaction. So the owner of the funeral company, if they know the chief of police, if they know the administrator at the hospital, if they've done other business in the past and people are very happy, and they know this person who owns the funeral operation, that individual is the reason people go there. Otherwise, they just look in the yellow pages and pick anything out, like buying, let's say, a kitchen chair. You can buy it from different stores. This is different. It's a personal service in that particular case.
And in funeral parlors, oftentimes the owner has their name on that business, or it's been a generational business. And
correct.
The third or fourth or whatever generation is running, and the name's there. But does the name always have to be on the business to generate personal goodwill?
No, absolutely not. As a matter of fact, I recommend that you don't have your name on your business because it also increases your liability. Okay? So I like to have businesses self-explanatory. For example, the company that I'm the founder of is called the Center for Financial, Legal, and Tax Planning, Inc. Okay? It doesn't say it's Bart Basi's firm. Okay? It's the Center for Financial, Legal, and Tax Planning. Why? Because we provide financial, legal, and tax advice on transactions. That's what we do for a living. Okay? And so a personal name helps for personal goodwill, but not necessary. I would like to think, and I don't mean to be belligerent in this at all with the statement, but I would like to think that you call me and other people contact me because they know Bart Basi, and they say, gee, we want Bart to help us. My son, one of my sons, is running the company now. We have several attorneys and CPAs working for us doing business transactions and tax work. And every once in a while, someone will say, I know Roman is good. I know your staff is good, but I want Bart to be there. Well, that helps understand that it's because of me. That's personal goodwill. When an individual's reputation is such. Let me give you a second example. Louisiana. I won't identify the company or what they do. You got to bear with me on this one. But this is a very, very large corporation where the two individuals who formed the corporation years ago made personal relationships with purchasing agents of Shell Company, of Exxon Corporation. So they knew the purchasing agents of these large oil companies in the world. Because of their personal relationship, when these purchasing agents wanted to buy these particular products that these two individuals' company created and started up years ago and have been running, they went there. So I was able to get letters from the purchasing agents to put in my file in case the Internal Revenue Service ever came back and said, why did you create $15 million of personal goodwill? Well, I could justify the fact that this company that was being sold had created such revenue because of the personal relationship of the two founders with purchasing agents of publicly held oil companies in the world, that was worth, and I could justify it mathematically, $15 million. And by the way, that alone saved us over $5 million in income taxes.
Wow.
Okay. I'm not exaggerating. This is absolutely, a specific. I just can't identify the company because people may recognize it.
So look, I've seen it firsthand. I've seen your handiwork, and I know. I mean, I've seen it play out several times.
Yeah, so that's personal goodwill. That's very, very important. It's the personal relationship of an individual that assists in generating revenue for the company.
So Bart, let me ask you this. There's been, I think, a little bit of a sea change in entity formation over the last 10 years. I see many, many more LLCs popping up these days than I ever did before. C Corp, I think, has gotten a bad rap because of the potential double taxation issues associated with it. What's your perspective on, if you were starting a business today, looking at, starting it up as a C Corp?
Okay. You've brought up two issues. Let me take them one at a time. First of all, LLCs, limited liability companies. It's been very, very good. It's been around for a long time. The purpose is to limit the liability of the owners. Now, this is important for everyone to understand. There are no tax returns for limited liability companies in the United States. So anyone who creates a limited liability company, their accounting firm or whoever files their taxes has to select how they want to file taxes. Do they want to file taxes on the limited liability company as a C corporation? Do they want to file taxes as a subchapter S corporation? Do they want to file taxes as a partnership? Okay, or, and this is very important for your listeners to understand, if there is a single person owner of an LLC, limited liability company, single person, the laws now say that that is a disregarded entity, and therefore the tax return must be the individual owner's personal individual tax return, which is terrible. There are a couple of states now that are even saying we will not even give you limited liability protection if there's only a single person owner to an LLC. So let me summarize quickly. Limited liability companies are good because they limit the liability of the owner, but there should be at least two owners. There should be a selection as to how the taxes are going to be paid as a subchapter S, as an LLC, as a partnership, or as a C corporation. That's important. There's one other aspect from a legal standpoint, Dominic, that I might mention to your readers because I find this being done improperly on a regular basis, and it defeats the entire purpose of having a limited liability company. And that is the use of DBAs, doing business as. If you are a limited liability company, you cannot use a DBA. The law is very clear. A limited liability company must have the letters LLC on every single thing they do. It must be on their stationery. It must be on their business cards. It must be on their invoices. It must be on their trucks. It must be on their buildings. It must be in every advertisement. They must notify the general public that they are a limited liability company. If they say, I've got a limited liability company, but I'm doing business as Jones Trucking Company, the general public thinks of Jones Trucking Company.
And what is the reason behind that law?
You have to notify if I'm running an LLC and Dominic, you're doing business with me, you've got to know I'm limited in my liability. You can't come after Bart Basi.
Mm-hmm.
But if I do it as Basi Enterprises, DBA Basi Enterprises, you think, well, gee, I'm a regular corporation. Or you might think, hey, he's not even incorporated. I can sue him if he messes it up.
Understood.
So I lose that ability. And I'm finding this. Let me give you two specific examples. I work a lot in the insurance industry. And I find a lot of insurance companies in the country are limited liability companies, and they operate as a DBA, Jones Insurance Agency, Smith's Insurance Agency, which is improper. They are now going to be held personally liable, and they lose the liability protection of the LLC because they're not notifying their clients, their life insurance clients or something, that they're a limited liability company. Now, we have a problem in one or two states and even counties. They will allow you to have a DBA. They don't care because they're not worried about the liability aspect. So anyone can ask and file in their local county courthouse a DBA. But I want to let you know that from a legal standpoint, not a tax standpoint, that's critical. Now, having said that, let me switch gears to entity because you asked me about C corporations also. Okay? There has been a stigma attached to C corporations in the past because people have said that it's double taxation. The profits are taxed to the corporation, and when dividends are given to the owners have to pay taxes. Well, be aware that dividends are issued by publicly held companies. So if you own stock in General Motors Corporation and General Motors issues a dividend, General Motors has no knowledge of who the owners are. The owners have no relationship to the operations of General Motors. So General Motors is considered an artificial person and therefore pays taxes. When that artificial person gives parts of its profits after taxes to people who've invested money, those investors have to pay taxes. This does not apply to privately held companies. Privately held companies, an owner is foolish if he gives himself or herself a dividend. If you need money out of the company, you take it as a bonus. You take it as an expense. You take it as a loan. but you don't give yourself a dividend. So double taxation doesn't apply to privately held companies. Now let's go to the next aspect. The 2017 tax law in the United States permanently changed the tax structure for C corporations only. It didn't permanently change the tax structure for individuals. It didn't permanently change them for subdraft trusts. It didn't permanently change them for partnerships. It didn't permanently change them for trusts, but it did permanently change them for C corporations. The law says if you are a C corporation in the United States now, you will pay a flat tax of 21%. You will not pay capital gains of 23.8%. You will not pay extra taxes on alternative minimum tax. That applies to individuals. It no longer applies to C corporations. Capital gains no longer applies to C corporations. You will simply pay a flat tax of 21%. Plus, some of the tax deductions are much greater. Example, you've heard of a limit on real estate taxes. A lot of states get mad at this, but the law says you cannot deduct any more than $10,000 of real estate taxes on a personal tax return. And this includes whether your partnership, subject to rest, because it flows through to your personal return. But a C corporation doesn't have that restriction. You can deduct all of the real estate taxes. Now, some operating entities are operating as partnerships, and they are deducting as an operating expense of the partnership that doesn't flow through to the partner's individual returns, real estate taxes. So be aware that there are tax benefits for tax deductions to C corporations and some partnerships, depending on how they're structured, okay? And some S corporations, but that's another, it gets confusing. Let's stick with C corporations. You can deduct on C corporations, you can't deduct in your personal return. Plus, how many individuals now are no longer itemizing expenses on their personal returns?
Right.
Okay. There's even a limit on contributions. Now, stop and think of a company. If a company sponsors a Little League baseball team, or the company donates money to someone, as long as a company uses a company check, it's not a donation, it's advertising. Remember, there's two types of advertising: name recognition, okay, and then special discounts. Well, when a company claims they donate money to a charity, but they're doing it in the name of the company, it's advertising. And there's no limit on how much advertising can be deducted, up to profits. Obviously, if you're going to show a loss, then the advertising can't be deducted, but it's carried forward. You deduct it next year. Where if it's classified as contributions, there's a limit. And also, this changes the contribution deduction on a personal tax return versus a company tax return. Now, you've got to make sure your listeners to this podcast understand that I would never tell them something that I personally don't do myself. So, Dominic, the question you should ask me is, Bart, the Center for Financial, Legal, and Tax Planning, Inc., what kind of entity structure is it? And my answer would be a C corporation.
Wow, there you go.
Okay? So I practice what I preach.
That's great. You know, we're about to the end here, and we could probably spend hours and hours. There's so much here to unpack. But I'm going to ask you what I hope is an all-encompassing question to our listeners out there who consist of, in the M&A Unplugged community, buyers, prospective sellers, accountants, attorneys. What overall advice would you offer to our listeners when it comes to tax?
Okay, I guess there's three things people should do. First, do not go to market until you've got your financial statements properly organized. Private companies, in many cases, get benefits that other people don't. And you'd be surprised how we have to clean up not just the profit and loss statement, but the balance sheet as well. That's very important. Recognizing assets that are not on the books. Recognizing the existence of company goodwill versus personal goodwill that's not on the books. Recognizing the fact that the profit may be understated because the private company wants to save taxes. So the accounting records should be scrutinized, analyzed, and make sure they're corrected prior to going to market. Second, okay, it is important to make sure that a buyer and or a seller understand the tax ramifications of a transaction. The different ways you structure a transaction are tremendous. Okay, just quickly, and I know I don't want to spend too much time, and I know you want to summarize this, but just quickly. If you're selling a business and you're renting a copy machine, you can't sell a copy machine because you're renting that copy machine. So it can't be listed as an asset on your books. And yet accounting rules now indicate that all leases should be on your books. So even though it may be an asset on your books, it's not an asset that can be sold. Okay. Number two, once your accounting records are structured, obviously the second thing is to look at the tax ramifications of different alternative structures. There are cases when I can actually show you it's better from a tax standpoint to sell assets than it is to sell stock. The taxes may be lower selling assets than it is to sell stocks. Okay. Conversely, when you're buying a company, if you're buying assets, then you've got to understand how to structure a company. Okay. And the third thing people should do before they go to market is to make sure they know how far they're willing to go, how far they're willing to bend. I hate it when sellers come to me and say, and I'll give you a specific example. A broker called me recently in the state of Florida. They said, Bart, we've got a problem. The seller wants, let me make it simple, $5 million. The buyer said they had a valuation done at $2.7 million. They can't be that far off. He said, so I told the broker, I said, send me how the seller decided his company was worth $5 million. Well, they sent me work that the accounting firm had done. And what they had done was done a valuation using three methods, okay, cash flow, market value, and assets. At the end of the report, they took a percentage of the market value and the cash flow. They ignored the assets. They came up with a value, and then they added on top of that all the assets.
Oh, no.
So they double dipped.
Yep, double dipped, yep.
When the broker saw that, he says, oh my God, I never realized that. So it is critical, the third aspect before they go to market, to make sure you know exactly what you're doing and what you think your company is worth. Have a proper valuation made. My company does valuations for accounting firms, law firms all over the country, businesses, just as an independent organization, to give them an independent value and say, this is it. And normally we'll give them a range. Now, some of them love it. Some of them say, well, Bart, my company's worth more than that. I said, prove it to me. So we do independent valuations. We're one of the few firms in the company that are independent. And by the way, we're authorized by different organizations, okay?
That last point you brought up is so critical. I see that from time to time where people do an analysis and then they add the assets on top of it. And in reality, your assets are supposed to be working for you, and they're the very thing that help you generate the revenues and cash flows.
Absolutely. Dominic, the broker, was stunned.
You can't add it on top. It's we've seen that before.
And when we talked to the seller and redid it, the value came out to $2.5 million, and the buyer had come out with 2.7. I said, take it and don't argue.
Yeah. There you go. Well, Dr. Basi, it's been such a pleasure for me to have you here today. I really appreciate all the information that you've shared with the M&A Unplugged audience. And people out there wanted to get in touch with you. How could they best reach you?
The easiest way is my email address. It's last name Basi, B-A-S-I, @taxplanning.com. And if they want to know more about me, just go to a website. It's www.taxplanning, all one word, taxplanning.com. They'll see what I look like. They'll get a complete background of myself, our company, and what we do. And while I'm not looking for work, I'm happy to help people. I must help. We must help. And sometimes it's you'd be surprised. We have no problems helping people if we can, but the best way to contact me is by email, and please reference this podcast or reference Dominic so I know that where it's coming from. I got a contact today. Someone emailed me today and said, my stockbroker recommended you because you help somebody else with their taxes. Can you help me? It's just a name.
Yeah.
I don't know who his broker is. I mean, it's hard for me to respond to some of those contacts. So it's important for me to, when people do contact me by email at b-basi@taxplanning.com or go to the website, that they reference Dominic, you, and I know, hey, they got me from the website.
Yeah, that's great. Well, your name is ubiquitous in our industry, and so I'm not surprised that you get calls from people. you've never heard of, and your name gets bandied around in more places than you probably want to know about. But thank you again so much. Really appreciate you being here.
You're welcome. It's a pleasure to work with you.
So M&A Unplugged community, I normally summarize here at this step, but I got to tell you, there's so much there that Dr. Basi talked about. Hopefully you've distilled from this conversation that there are so many ways to do proper tax planning, and getting to it early and often really can help you understand what your walkaway is, because it really is true. It's not so much how much you got paid for the business, but how much you keep in your pocket. And there, are people probably not in the class of Dr. Basi, but lots of people who understand this that you need to reference. And please feel free to reach out to Dr. Basi. All of today's information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at 𝐸𝐮acquisitions.com, or feel free to reach out to me at drinaldi@𝐸𝐮acquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at 𝐸𝐮acquisitions.com.